really appreciate Stacy asking me. I usually do a tax update and real estate investors update in January each year. But there's a lot of things going on right now, and there are some, this year there's actually some things you could possibly do before year end to help your tax bill. So I went ahead and took this earlier spot. Everybody's very concerned about what's going on with the tax bill, Biden's tax plan. And honestly, it was pretty scary coming out the original proposals for investors. A lot of those proposals have left the room. So what's left right now, the bill that's in Congress right now, is a much better bill for investors. And we don't know if it's going to pass. So what I have generally throughout here is I've got the information that we have that we know is going to be effective for 2022, and then what we think is going to happen with this bill. That generally what people think are going to get passed. It could change drastically. The Senate will probably make some changes to whatever the House changes. It could get stuck in the Senate. Could not go anywhere. So there could be changes. Is that working yet?
Well, it's working, but if you show your next slide, and then I'll play with it some more.
Okay, so just to start with, these are in place, the standard deduction amounts. Originally, all the tax rates were going to go up with a maximum tax rate of 39.6, I believe. None of that happened. So the tax rates, the standard deductions have gone through. They've been adjusted for inflation. So this is really pretty much the same. The one item that's different within the itemized deductions is we've all had the SALT limitation, which means your deductibility of your state and local taxes, which has been limited to $10,000. So for a lot of people, they don't itemize anymore. It's just been the standard deduction. But there's two things that are happening with that. And I'll talk about, there's another way to bypass that limitation this next year, or actually starting in 2021. And the other thing is what's in the tax bill right now is an expansion of the SALT limitation up to $80,000 instead of the $10,000. So that will capture a lot more people that will be able to itemize this next year. So it looks like we have it now. So that's why this is crossed out, $80,000, and that is set to stay there through 2030, but it's not law yet. So we're still waiting. And the property and personal estate income taxes. Everything else within itemized deductions, I believe, is set to stay the same. There's still no deduction for the miscellaneous deductions, subject to 2%. So investment fees for, stocks, things like that. And the mortgage interest is still limited, but this is only on the homes, your residents, not on investor mortgages at all. There you go. So these are the 2022 tax rates that have been approved. These are already out by the IRS. They stayed pretty much exactly the same, as in they were only adjusted for inflation. So you actually have a better, the 35% tax bracket, for example, is up higher. And there's no 39.6% bracket. Originally, they were going to be compressed. You were going to reach these top rates higher, much faster, and then there was the additional top rate. So this is actually good news. Those are already released. The long-term capital gains rates. This is another area that was very scary. So right now, these are the rates. These are the rates for 2022. Currently, there is no increase in capital gains rates in the bill that they're working on. So that's a good news too. They were going to raise it. First, there was talk of up to 28%, then it was 25%. Most people actually within the industry thought it would be about 25%. So actually a little surprised it didn't go up. These are historically low rates. And you still have, I mean, even if you've got 15%, if your gross income on a married filing jointly is below, you know, 517,000. So those are really good rates. That's why I mentioned, you know, Stacy, if you, maybe it's not a bad thing to take the capital gain if you're selling one of those properties, because if you're overpaying for your replacement property by 15%, why not just take the gain, pay the gain? It's your adjusted gross income. Yeah. Yeah. So the 41,675. Yes. If your income is below that, you could have if you had. Yes, for the year that you incur the gain. Well, no, it's for the next. I mean, yes. So, but that 41,675 includes the gain. So, you know, if you had income of 20,000, a gain of 40,000, and then your standard deduction of 25, yeah, it's going to be a 0% rate on the gain. So it's a little misleading. This is not just the gain itself. These rate schedules, that includes the gain plus the rest of your adjusted gross income. Yeah.
So your recommendation is maxed that out now, because you anticipate those gains going or the rates going up. So could you summarize? So maximize all. Yeah. You're gonna have to pay a gain. Do it now.
Yeah. So the question is, should you be maxing out those rates now while they are at the historical lows? And because is it expected that the gains rates are going to go up? Yes. Even these capital gain rates here, I mean, the brackets are set to expire in 2025. So that could change from the 15% brackets and everything. But yes, I think they're historical rates. This has definitely been a target for an increase in tax. So yeah, if you decide to go ahead and take that at this point in time, I think you're doing all right. The other you get that 60% capital gains rate deduction on investment properties. So your Idaho capital gains rate is basically 3.5% to 3.4%. So your total maximum gain there is 23.4. Yes.
Clarification. So that's 2022 rates for a capital gain occurs in 2022.
Yes.
Okay. And is there any chance of a change that would go retroactive to the beginning of 2022? Like there was discussion of retroactive capital gains taxes for 2021.
So the question is, if they change the capital gains rates in 2022, could they make it retroactive back to January 1st? In general, I would say it's unlikely, but certainly that was on the table in this last act, and it went away. But I think most people think it's terrible tax policy. You have to be able to allow people to plan. So I think it's unlikely, but I don't know. It could happen. Let's see. Okay, so the Build Back Better Act. This is where we are currently. So originally proposed, these are some of the comparisons, to increase the top individual tax rates from 37% to 39.6, and that was starting at 452. Now I believe it's starting at the 539. So that was that compressed bracket and a much higher rate. So instead, what they're doing to what they have in the bill currently to increase revenues is that there's a surcharge on adjusted gross income of 5% if you have over $10 million in income, and an additional 3% up to 8% surcharge over over 25 million in income, obviously targeting the uber wealthy. That 10 million, those are adjusted gross income rates. So that would include capital gains and ordinary income. Secondly, net investment income tax of 3.8%. They were going to expand the base of that. They wanted to expand the base of it to include all trade or business income if your AGI is over 400,000. That's that's not great for people who are self-employed, small businesses, because they were getting, it's an investment income tax. It's not meant to be on active trade or business, or originally it wasn't meant to be. Now they do have that included on all trade or business. So any profits from small business are, some of the planning techniques we've used, having an S corporation so that you don't have to pay as much in FICA and Medicare tax and things like that. That's basically to make up for that. So it's encouraging, that will trap a lot more people. To extend or make permanent certain existing credits, these are different earned income credits, the child tax credits. Several of them are, there was a lot of advance payments, the advance payments on those have been expanded, and the child tax credit is fully refundable, which isn't, before it hasn't been refundable. It's only been a credit against taxes owed. So those are getting a boost too. Retirement plans, there's a bunch of different things going on with retirement plans, and this is meant to curb, also again for the ultra wealthy, to curb their ability to use Roth IRAs and retirement plans to really grow their income tax free. So one of those things is that they want to limit the IRA contributions when balances reach $10 million and accelerate the required minimum distribution on these accounts. So basically they're saying you can't leave that in there and keep assessing all this wealth without paying any tax on it, which is what the Roth IRA does. That is still in there. That probably will pass, but at least originally it was going to be effective after this year. Now it's set to be effective in 2028. So again, they're letting people plan. If you've already got a plan to get this much into your Roth IRA in the next 5, 6 years, you're going to be able to do that. So that at least alleviates some people's concern on that. There's no Roth IRA contributions for high earners of over $400,000 in income, and no backdoor Roth conversion. If you're not familiar with that, you have to have earned income to do a Roth or regular IRA, but the limitations on the regular IRA are fairly low. So people would do a non-deductible regular IRA, then turn around and convert it to a Roth IRA, and that's how they were able to get around those limits. There's no limit. So they are shutting those down. Again, probably not effective till 2028. That's correct. This was the original proposal, and this is still in there. Yeah, it stayed. Well, this is the difference. Yeah. This was effective after. All of these changes would have been effective beginning January 1st, 2022. They're still in the bill, but they become effective much later. So you can still do all these things until 2028, whereas originally proposal saying, no, we're cutting that off right now. Yeah, you can consider it. I'm not, sorry, the question was it's a strategy you should consider. There are advantages certainly to a Roth IRA, and that depends, one, on how long you plan on leaving those funds in there untouched. Are you going to be using them in the next 5 years? Then maybe you don't want to do that. The thing is, when you convert a Roth IRA, a regular IRA to a Roth, you're paying the income tax rate, today's rate. So you are paying the tax up front on that, and then it grows tax free. So if you have, let's say, and as a real estate investor, let's say you have a bad year, and you have losses coming through, that'd be a great year to convert your Roth to a Roth IRA, because it's non-taxable then. And real estate investors, real estate professionals have more of an ability to do that than just regular investors. So.
What about like retirement planning? So converting like 401k to Roth.
It's really the same. I think they are good. I didn't have that up here, but I think they are going to limit that also. That's in the bill too. But yes, the effect is still the same. You're still going to pay the tax upon conversion.
Oh, I'm just wondering, would it make sense to, for me, for example, for me to retire now so that I can convert all of my 401k over to Roth in the next, whatever, 5 years instead of waiting to retire?
Yeah, that's a good question as far as the timing of it. Do you want to keep working for 5 years? Your income's up at a higher level, or should you just go ahead and retire and go ahead and convert now when as your rate drops because you're at a lower bracket? You should just really, I mean, we could do an assessment on that. Just basically, pencil that out.
That's a great question, but I think when someone asks that question, the real answer is just retire. That's what you want.
Are you looking for a reason to retire? Yeah. One of the other things was the permanent excess business loss limitation. This was introduced in, I believe, the Jobs and Tax Act, where basically in the past, if you own a small business and you have active trader business income coming through, if you had losses, you could deduct it against any of your other income. Capital gains, didn't matter what it was. They put a limitation on that. So on a married filing jointly, you can deduct now up to 524, but then you're limited. So businesses that were doing poorly in the past could offset all these capital gains. People could kind of the same thing, take advantage of the fact that they have losses this year and run capital gains against them or other income, investment income. They have, that was part of the Tax Act, the Jobs and Tax Act of a couple of years ago. They suspended it last year, so that, or actually 2 years ago, I believe in 2019, so that you could use it. Now they've put it back in. And before you could carry it forward as a net operating loss, which means you only were limited that 1 year. The next year it became a net operating loss and there was no limitation. Now it is not going to be a net operating loss. You're still under that same limitation. So you can't use it as a net operating loss the next year. It's just a little bit tougher for small businesses, basically. They have losses to use that. Corporate taxes. That was one of the other big selling points of Biden's tax plan, is that he really wanted to raise the corporate tax rates. That has not happened. There's no change to corporate tax rates in the bill currently. Also, they wanted to impose a 15% minimum tax on corporations with book income in excess of $2 billion. This is both domestic and worldwide income, and there's different reasons for it. What's in the bill now is the same. It's actually in excess of $1 billion, so it's gotten a little bit tighter. What happens is book income, when you have a financial statement and you've got your book income at $2 billion, corporations can turn around and then write off so much stuff with the depreciation and other tax advantage planning that they end up paying no tax. Amazon's a perfect example. They have tons of income, book income, but they use depreciation to have no taxable income. So it's a way to stop corporations from having a tax-free income. So that's what that is. I don't think most people shed a lot of tears for the corporations that are making more than $1 billion a year. They might have to pay some tax now. And then there was some tax incentives for locating jobs and businesses in the U.S. And I haven't heard of. I have not been able to find out if that's still in the bill or not. But basically, this also kind of is an incentive to locate your jobs and businesses in the U.S. because prior to this, you could outsource those jobs and have different tax laws in different countries. Now it doesn't matter. This is on worldwide tax income. They're still going to tax you on it. And it's on that book income, not with adjustments. These are some of the other original changes that are no longer on the table, which is great, is the repeal of the like-kind exchanges or a limitation of a deferral to $500,000 per year. Stacey had mentioned I'd been at that 1031 conference with a lot of very smart people and people who've worked in this industry for a long time. They said they're not going anywhere. And what I've told clients before is I don't think they're going anywhere. There's too many Democrats and Republicans that hold a lot of property. They have a lot of property too. They don't like that they could go away. Along with that, there were some proposals in there on the estate tax and trusts and other ways to tax capital gains. And for example, right now, I think we all know that you can keep 1031 a property continuously until you or your spouse dies, then it gets a step up in basis, and your heirs don't have to pay tax on it either. So that's part of that. So what they wanted to do instead then, okay, well, they were going to tax capital gains. They were going to tax the appreciated value whenever there was a transfer of property. So in an inheritance, when it got transferred to the beneficiaries, or if you gifted it, you were going to pay the capital gain right then. And I believe that Canada, I'm not real familiar with it, but I believe Canada has a tax system similar to that. And so then, and another one is, so that was and that would eliminate the step up in basis and assets of date of death. So you'd be paying capital gains. The other one was changing the timing. Not only are they upon transfer, but if you had a trust too, they would make you, any kind of non-corporate entity, you can't just hold it forever. You would have to actually pay whatever appreciation there was after 90 years. There's different timing in there. It talked about how many years they wanted to go for, if you had to go do it every 25 years, but there was one in there for 90 years. And all these things would be, by the way, a nightmare to figure out. You know, you're talking about, okay, this property's been in the family for 150 years. Who knows what the basis of that is? So it would be definitely very difficult. And then capital gains were going to be taxed at ordinary rates for AGI in excess of 1 million. And that was that clawback date with the effective date of April 28. We had several businesses in Boise, startups that sold this last year. And I can tell you their shareholders and partners were awfully nervous because they had no idea what rate they were going to be taxed at. And that's that bad tax policy that we talked about. Now, instead, instead of changing that capital gain being taxed at ordinary rate, they've just done that surcharge on all adjusted gross income. Let's see. Oh, no valuation discounts for lack of control or marketability. This is something that people use in estate planning quite a bit. If you have a family limited partnership, let's say you've got a bunch of property in that, you can gift, 10% of your interest to a child, and they really have no say-so in the business because they've got 10%. It's not valued at fair market value. It's given a discount because they have a lack of marketability. They can't go out and sell that to anybody, and they also have a lack of control. So that's really an estate planning issue, but that has not happened either, so that's good. Carried interest, which is, I think they talk about carried interest a lot, and most people don't know what that is. But basically, it's if you're a partner in a partnership and you're a profits only partner, or you've traded services for your interest. In other words, you have not put any money into the partnership. You don't have any skin in the game. The treatment of your income on that has been capital gains, and they were looking to tax that as ordinary income in certain cases. Cryptocurrency reporting. I'm not sure if this is still in there or not. Cryptocurrency reporting is interesting because the government currently doesn't have a way to really track the trades on that, the sales and the transfers of that. So there's some 1099 reporting. I think it's still in there as far as being a requirement. They will do that eventually. So it just means that it is very difficult. I don't know if any of you do any cryptocurrency trading. Yeah, the reporting on it is huge. So it's basically to figure out what's been sold, what's been transferred or exchanged. Basically, it's taxed at an exchange if you exchange one type of crypto for another. So that was just another one of the things in the bill to kind of tighten up the taxing on that. The other thing is there's 12-week paid family leave. That is one thing the Republicans, I believe, wanted in there. It was out. Now I've heard it's back in, but at a 4-week paid family leave. And I believe that's government paid. Not really sure how that one's going to turn out. So, but anyway, the fact that these things were all dropped currently is certainly good news. They are off the table right now, except for this one might still be in there. There has been no change on the carried interest. Any of these, there's been no change to the current law. The carried interests, they were, yeah, that's what that is. And there's some other, I didn't put all of the changes in here. I just kind of put the ones that most people are concerned about. I think there's several of the provisions that they will come back and try again at. There's been a lot, what I have gleaned or been told at different conferences too, is that there is more acceptance of the thought process of let's tax people's appreciation. That's a way to certainly generate more income. That there's been more acceptance of that. So I think it will probably be brought up again. I do think that the carried interest profits is another thing that will be brought up again. There's several of these things that really only are affecting the ultra wealthy. So most people don't pay attention to them, and some of them they're probably better revenue generators than some others, but. I believe so.
Yeah. And there's no capital to pay it if they're buying them every year. So there's some sort of
right. And most of the times they don't value it. But if you've got a carried interest in, for example, you know, some startups that are actually coming up with a value every year for investors, then they could do it that way. Sometimes it works, or maybe it's just you. Okay, one of the changes that has been put into place by all of these states is the workaround of the state and local tax limitations within itemized deductions. So if you have, for us that are in this room as investors, if you have a partnership, it's got to be through a pass-through entity. But if you have a partnership LLC that owns a bunch of rentals, you can have the partnership pay the state tax on that. Then it's a deduction. It's a deduction just like property taxes. So you're deducting it off of your LLC income before it ever hits your individual income tax return. So this is only for pass-through entities, either partnerships, LLCs, S corporations, and trusts actually too. So then it never hits your individual income tax return as a tax paid at that point. You've already got the deduction for it. And also, if you don't have enough deductions to itemize, let's say even if you only owe $5,000 in tax, you can still get that deduction through your pass-through entity. So that's what that is meant for. Certainly, the SALT limitation going up to 80,000 kind of, you know, helps a lot of people too. So this is not as important as it was a few months ago, let's say. The cons on that is you can't really use it in a partnership that has tax exempt partners or members that are IRAs, because they are really not, they don't owe any tax. So if you pay tax, they end up paying a tax that they would have never had to pay. I mean, their proceeds or, you know, their distributions are reduced by that amount. So it doesn't work for entities that have tax exempt partners. And also on non-resident partners, it doesn't work so great either because it's hard to do an allocation of which state that tax is going to. So it gets a little bit difficult, but I think for some, those allocations and go ahead and get that figured out. So, and I think we've come up with, you know, if you have a dollars, that's going to save you about $2,500 in state tax or in federal taxes. That's really what the savings is. You get the deduction, which is going to be multiplied by your current tax bracket rate, but about $2,500 on every $100,000 worth of income. So that's why I have it, and you need an assessment to see if it's really worth it. And also, if you just hold all your rentals individually as sole proprietors, or reporting them on your 1040, not as a partnership return, or and you don't ever want to hold them in an S corporation anyway, then you really can't use that. But it does certainly works for bigger partnerships that have higher income. And it also works for active trader business too. It's not just for investment rentals or anything. Any active trader business, paying it at the business level is much better for the partners and shareholders.
You say taxes exempt, like if I bought my building, well, okay.
Yeah.
So that would not get.
No. It might be beneficial to your partners, but it's detrimental to you. All it really ends up doing is reducing your distribution by that amount of tax paid, because that tax is going out to the state and you never owed it in the first place, or your IRA never owed it in the first place. So, yeah. This was a question that Stacy had given me. Just want to remind you, don't forget about the QBI, qualified business income deduction. Most rentals are going to qualify for that unless they're triple net leases one way or another. So that's a 20% deduction. You want to make sure is in there. There's obviously limitations on that depending on income levels and how much what your cost basis is in your assets that are held. But you always want to be making sure your accountants are looking at that. I've had several investors that are starting to, because things are so high here, there are some states that have good deals. So you can look into investing in other states on that, although you obviously have to be comfortable with having someone else taking care of all your rentals in another state, and that you don't really have that same kind of control over them. The timing of income recognition and expenses, this is just in general. If you have improvements you need to make on a rental or expenses, you can even pay mortgage payments a month early. Do that so you get 13 payments one year, 11 the next, and kind of, do that. Or it's mostly just the timing of when the expenses come through, and go ahead and get that deduction a little bit earlier. You wouldn't want to do that if you know the tax is a lot higher in the next year. This year, it's not going to be, so it's great to go ahead and get that expense up in there early. But strike that. If the next year taxes are higher, wait and take the expense then. So it's worth more. The other thing was recognizing the gains based on the current rates, and go ahead and paying the tax on it now. And in a 1031, when you roll forward that property, you get a much lower depreciation because your cost base is lower. You don't really get the depreciation deductions. If you pay the gains now, you get a much higher depreciation deduction, and that's at the ordinary income rates. So it can make sense to go ahead and take the hit now, pay the tax now, and get the bigger deduction. The other thing is installment sales. If you sell something on an installment sale, obviously you only have to pay the gain as you get the income. It's a little bit difficult because interest rates are so low right now. Most people are going to qualify for a loan. You're not going to make much on interest on that. It's really more of a the gain deferral. But that's if you don't want the cash right now. Don't need it. You just want an income stream without having to do much. An investment in opportunity funds. You can defer your gain in that, but it's a long-term hold to make that investment worthwhile. And there's certainly hoops that you need to jump through. And the time period for really getting into those would have been before the end of this year to get the best benefit. But they still could be a good deal if you're inclined to have some opportunities to do that. I would say you would want to, just in general, and looking at these, I'm thinking you would need gains of about $500,000 to even bother with it, because you're going to be holding it for a long time. Delaware statutory trusts. Delaware statutory trust is basically a legal entity that holds title to one or more income producing commercial properties, sort of like a REIT, but a Delaware statutory trust does have a direct ownership, like as almost similar to a tenant in common ownership. So I have seen certainly promoters of the Delaware statutory trusts have been talking about it a lot. I see it as a useful tool if you have an exchange that you really would like to complete and it's going to fail otherwise. You can get into a Delaware statutory trust for a portion of your replacement property pretty quickly. You still have to do it before the end of the 45-day identification period, but still, it is a way to, if you're not finding any properties that you can exchange into, you can go the way of a Delaware statutory trust. Most of what they're holding right now is commercial properties that are possibly long-term leases, but they do qualify for 1031 replacement property. Yeah.
Can you 1031, say you held a property in your personal name, and you sold that, can you take that money out of the capital gain out of that and put it as an LP in the situation and consider that a 1031 exchange? So privately owned.
Yeah.
And then take the gain and put it into a syndication. Can you do that as a 1031?
No, not only in a Delaware statutory trust. You've got to have direct own. Yeah, I believe so, because you've got to have, it's got to be the same taxpayer that's doing the relinquished and replacement properties. So you have to have a direct ownership. You can't exchange a partnership interest or S corporation stock for real property. That's not considered qualified property. You actually have to have title to the property. And through the Delaware statutory trust, you can do that. But yeah, that's it. Anybody have any questions? I do. Well, yeah, I think something will be passed, and I think it will probably be passed before the end of the year. They've got to do something. I mean, the infrastructure bill has passed, and this is how they're going to pay for that. So is through this is the economic side of that. I do think there'll be some arguments still, but I think it will pass. Yeah, there's huge, and the question is basically, there's a lot of dispute between what the bill will and will not accomplish, whether it will really be a revenue generator, will it actually pay for as much of the infrastructure bill as they are saying it will? You know, there's absolutely huge disputes going on right now. We have one commentator that's saying, you know, this is great, this will stop inflation. The others are saying that's absolutely absurd. It's not going to stop inflation. Any of those types of consequences of the bill, the debate will rage on, but those types of consequences of bills don't really stop Congress from passing them. So it really doesn't. I mean, every time there's a bill passed, we go through, years of this was an unintended consequence, and this part, I mean, it makes no sense. So this bill, actually, they probably spent more time on than some of the other bigger bills, but I think it will be passed. We're not sure of all the details. And I'm happy to, when the bill is finally passed and the actual tax effects, I can certainly send Stacy an update on that and a little synopsis so she can send it out too. I mean, there's going to be tons of writers out there that are summarizing the effects for you, but more directly related to investor real estate investment strategies, I can send a little summarization on that. Okay.
Thank you so much.
Thank you. Bye.
We got your earbuds and.
I don't know. I don't know.
I don't
what-
totally sound with it.
That's okay. Okay, so I took notes because I do that thing. And so I was going to try to help summarize. And if you guys are getting this on Zoom, great. If you're not, sorry. And I'll probably need your help for sure, Arla. But what I understand is there was a target to increase capital gains and do some crazy things, but they did not do it. Is that correct?
There are no